Hello and welcome to my channel. This is Grow Your Money, where we focus on a systematic plan to generate consistent income from the stock market. I'll walk you through how I've used the options wheel strategy. You'll see the full process step by step with actual trades and results. So stick around, subscribe, and let's get started with Jim. Grow your money. Remember, trade the plan, not the panic. Hey everyone, I'm Joe, also known as Joe of Many Trades. Welcome to the gym, the Grow Your Money series. I created this series of videos originally for my family, so they could grow their accounts right alongside me. For those who call me brother, dad, or uncle, this is the same strategy I've been using to generate consistent profits over the past 3.5 years. I know options can seem overwhelming at first, but when it comes to family, trust matters. I wouldn't lead them astray. And even if you're not related to me, I invite you to follow along. Everything I share here comes from real trading, real results, and a process I'm confident in. That said, this content is for educational purposes only. Please do your own research and consult with a qualified financial advisor before making any investment decisions. If you find this helpful, please like and subscribe so you don't miss future videos. And if you'd like to support the work I'm doing, there's a Buy Me a Coffee link in the description. Your support truly means a lot. Thank you. Let me just say this up front using the options wheel strategy. I've doubled one of my accounts over the past 3.5 years, and across all my accounts, I've averaged around 25% annualized returns. This strategy is both forgiving and powerful, and by the end of this video, you'll see exactly how I've used it and how you can start applying it step by step. If you're looking for a systematic plan to grow your accounts, you're in the right place. So now that you've seen what's possible, let's break down the plan that gets us there. Here's what we'll be covering today. This video lays out the entire framework, but we're just scratching the surface. Each of these topics will get its own shorter explainer and walkthrough in the upcoming videos. Think of this presentation as your roadmap. The deep dives come next. And if there's a specific part of the wheel you want me to break down sooner rather than later, drop it in the comments. I actually read every one. And of course, if you want to follow along step by step, don't forget to like, subscribe, and hit the bell. When I first started investing and actively trading, I told myself to stay far away from options. They seem complicated, intimidating, and honestly, like something only experts should touch. But once I started learning how they worked, things really started to click. Options aren't magic. They're just tools. And once you understand the basics, they make a lot more sense. Before diving into the wheel strategy, there are a few fundamentals that really matter. If you're brand new to trading, I recommend at least a year of stock trading experience first, just so you understand how the market moves. And if you're starting from zero, no problem. Paper trading is a great way to practice without risking a single dollar. Now a quick foundation. Options are derivatives, which means the value is connected to an underlying stock. Each contract represents control over 100 shares. So when we sell puts or calls, we need to be prepared for what that means. In the wheel strategy, we're not buying options, we're selling them. That lets us collect premium up front, but it also means we need to understand the mechanics. And one of the most important pieces is delta. Delta is basically the probability of your option expiring in the money. It's one of the key factors we use when choosing trades. And I'll show you exactly how to use it later in the series. When you feel comfortable with these basics, you'll be ready to start applying the strategy. The goal here isn't to rush, it's to build confidence and know exactly what you're committing to. If any of this feels new or confusing, take your time. Review the resources I've linked, including videos from Options Play. They really helped me when I was getting started. The options wheel strategy is just that, a strategy. It's not a secret or a shortcut. It does take time and effort, sometimes just a couple days a week, other times almost daily. To get started, you'll need to understand how options work, have approval from your broker, and be able to trade in the 100-share blocks. Most importantly, you'll need patience. What it's not is a get-rich-quick scheme, or something you can completely set and forget. It's not easy on small accounts, and it's definitely not immune to market conditions. The key is to approach it realistically knowing what it takes and what it doesn't promise. Let's take a moment to break down what options really are. At their core, options are simply contracts between a buyer and a seller. The buyer pays a premium, and in return, they get certain rights tied to a stock. As sellers, we're the ones collecting that premium up front. An easy way to think about this is like insurance. When you sell an option, you're essentially acting like the insurance company. The buyer pays you a premium for the right to take a specific action, like buying or selling shares, at a predetermined strike price by a certain date. In exchange, we take on an obligation, and that's where our income comes from. Now, options can get complicated fast, but we're going to keep things simple. There's one Greek I want you to focus on. In plain English, delta represents the probability that the stock will reach the strike price by expiration. That makes it one of the most important factors when choosing trades, because it helps us balance risk and reward. You'll see the other Greeks on the slide, gamma, theta, and vega, but we won't cover those here. If you want a deeper dive, I highly recommend the resources from Options Play. Tony Zhang and Jessica Inskip explain these better than anyone. So for now, here's what you need to remember. Options give the buyers rights and sellers obligations. And as sellers, our goal is to collect premium consistently and manage risk effectively. With that foundation in place, let's move on to how the options wheel strategy actually works. Now let's break down the 4 key parts of an option contract. These are the pieces you need to understand before we get into the wheel strategy. First is the date of expiration. This is the last day the option is valid. After this date, the contract simply disappears. If you sell a contract that expires on January 19th, the buyer has until that date to act. Otherwise, it expires worthless, and we keep the premium. Next is the strike price. This is the price where the buyer can choose to buy or sell the stock. So if you sell a call at a $50 strike, the buyer has a right to buy your shares from you at that $50, even if the stock is trading higher. So if you sell a call at a $50 strike, the buyer has the right to buy your shares from you at $50, even if the stock is trading higher. Then we have the underlying stock. This is the stock the option is tied to. And as sellers, we need to own or be prepared to buy 100 shares for every contract. Also, make sure the stock is one you're actually comfortable owning, because with the wheel, you eventually might. And finally, the premium. This is the money the buyer pays you up front. That's your income for taking on the obligation in the contract. Premiums change based on volatility, time, supply and demand. All of that shows up in the bid and ask prices. Understanding these 4 components is the foundation for everything we're going to do in the wheel strategy. Once these make sense, the whole system becomes a lot easier to follow. Now that we understand the basics of an option contract, let's talk about the 2 types of options we actually use in the wheel strategy, calls and puts. And remember, we are always the sellers. We get paid up front. In exchange, we take on obligations. Let's start with calls, specifically covered calls. This is the bearish side of the wheel. We're assuming the stock will stay below the strike price. If it does, the call expires worthless, and we keep the premium. If the stock goes above the strike, we're obligated to sell our 100 shares at that price. And that's fine, because we still keep the premium, which lowers our overall cost basis. Now for puts. Cash secured puts. This is the bullish side. We're assuming the stock will stay above the strike. If it does, the put expires worthless, and again, we keep the premium. If the stock falls below the strike, we're obligated to buy 100 shares using the cash we set aside, and the premium reduces our effective purchase price. Here's the key takeaway. As sellers, we get paid upfront to take on obligations. Our job is to manage those obligations strategically. maximizing income while controlling risk. Covered calls means you're ready to sell 100 shares. Cash secured puts mean you're ready to buy 100 shares. That's the entire engine of the wheel strategy. When I first started trading, I was jumping from strategy to strategy to strategy. And honestly, I was losing money. Not because the strategies were bad, but because I was all over the place. At that time, I was teaching 4 preps, grading, planning, running robotics. My schedule was ridiculous. I didn't have time to actively manage anything. So in June 2022, I finally forced myself to do something different. Pick one strategy and run it systematically. No jumping around, no shiny objects to chase, just one plan. I started with a completely hands-off version of the wheel. Sell the put, sell the call, let everything expire, reset, repeat. This is actually the same approach Options Play uses in their backtesting. And it worked. It wasn't flashy, but it was steady. 15.1% annualized gains versus 4.94% for the S&P 500. This is the systematic plan that finally stopped the bleeding for me. Then, in April 2023, when life slowed down a little, I shifted into the more active version, the one I use today. Buying back calls around 80%, puts around 50%, redeploying capital faster. And that change made a real difference. 25.2% annualized versus 16% for the S&P 500. Same strategy, just managed smarter. So whether it's the hands-off version or the optimized version, the wheel works because it's systematic. It's a plan you can follow, not a panic you react to. This graphic shows why it's called the wheel strategy, a systematic process designed to generate consistent income by selling options. If you're starting with cash, you start at the beginning of this diagram. You begin by selling a cash secured put. That means you're agreeing to buy 100 shares at that strike price if assigned. You'll need enough cash set aside to cover that. If the stock stays above the strike, the option expires worthless, you keep the premium, and you can sell another put to restart the cycle. If you already own 100 shares, you can start by selling a covered call, which is at the bottom of the wheel. That's agreeing to sell your shares at the strike price if assigned. If the stock stays below the strike, the option expires worthless. You keep the premium, and you can sell another call on that stock. If you own fewer than 100 shares, you can either buy more to reach 100 or sell what you have and start fresh with a cash secured put. The beauty of the wheel strategy is in the cycle. Sell a put until you own shares, then sell calls until you sell those shares, and repeat. At every step, you're collecting premiums and putting time on your side. In the next slides, I'll show you how I apply this strategy and the tools I use to make it efficient. Here are the optimal trades based on guidance from Options Play, and these are the same rules that shape the foundation of my own approach. On the left, we have cash secured puts. You'll need the cash to buy 100 shares. The sweet spot is typically 30 to 45 days to expiration, and we usually look for a delta around 40. For management, you can buy back the trade at 50% profit, or simply hold to the expiration. Both approaches work. On the right are covered calls. Here you'll need 100 shares, and the optimal expiration is around 45 days. For calls, we typically look for a delta around 15 and buy them back at 80% profit or hold to expiration. Words of wisdom here are the most important rules in the entire strategy. Do not sell puts on stocks you don't want to own. And do not sell calls on stocks you want to keep. These guidelines create structure, discipline, and consistency. This is a systematic framework behind everything I do in the wheel. This is the plan. Here are the tools I use to run the wheel strategy efficiently and how they fit into a balance of cost and effort. Let's start with Options Play. This was one of my first real step-up tools. It helped me understand probabilities, find trade setups, and visualize the wheel strategy in a clean, structured way. I actually started with the paid version, but over time, as my workflow became more systematic, I weaned off of it. That said, I still recommend it, especially if you're new. They offer a 30-day free trial, and their education alone is worth it. Next is thinkorswim, Schwab's flagship platform. Completely free with an account, extremely powerful, and honestly, one of the best places to analyze and place trades. There's a learning curve, but once you get comfortable, it gives you everything you need. Then we have Fidelity's Active Trader Pro, another excellent free tool. And it's great if you're someone who wants intuitive layouts with institutional grade stability. For me, it was the most thorough training required before getting approved for options. Finally, Google Sheets, my personal command center. This is where I track performance, journal trades, calculate returns, and organize everything across my accounts. It requires the most effort up front, but the customization and clarity you get from building your own system is absolutely worth it. In my gym walkthrough videos, you'll watch me actually use these tools, placing trades, managing positions, tracking returns, and even paper trading when it makes sense. The whole idea is to bridge the gap between theory and execution, so you can see exactly how a systematic plan plays out in real time. The wheel strategy has a set of advantages that make it one of the most forgiving approaches in options trading. First, time requirements. You don't need to stare at charts all day. Whether you manage it 1 or 2 times a week or 4 or 5 days a week, the strategy can fit your schedule. When life is crazy, it still works. When you have more time, you can optimize it. Second, your directional view doesn't have to be perfect. This strategy is really forgiving because you're collecting premium up front. The stock can wiggle a little, drift sideways, even dip or pop, and you can still come out ahead. You don't need to nail the direction every time. Third, you're collecting premiums consistently. Every expiration cycle, every time decay cycle, every trade, premium is coming in. It's like generating rent on your money. Fourth, you don't have to win every trade. And this is huge. With a wheel, a single losing position doesn't blow up your account because you have cash or shares backing the trade. You adjust, roll, or simply hold shares until the next opportunity. It's building to be flexible and forgiving. But here's the one thing you must do right. Pick stocks you actually want to own. The entire strategy becomes safer and smoother when you choose companies you believe in. Because if you do get assigned, you're not panicking. You're holding something you're comfortable with. So the big takeaway is this. The wheel is a systematic, adaptable, and controlled strategy. It gives you structure, premium income, and room for error, whether you're starting with cash or already own shares. Let's talk about the challenges you're going to run into with the wheel strategy, because yes, it's forgiving, but it's not magic. First, getting your directional view right on puts. You don't need to nail the market, but if you pick the wrong strike, you will end up owning the stock, whether you plan to or not. Second, small accounts. Remember, one contract equals 100 shares. If you have a couple $1,000s to work with, your ticker choices shrink fast. Planning becomes everything. Third, stock selection. This is a non-negotiable part. Never sell a put on a stock you wouldn't be proud to own long term. Later on, I'll show you the exact data-driven filters I use so you won't feel like you're throwing darts. Fourth, taxable accounts. Premiums usually get taxed as short-term gains, which means Uncle Sam gets pretty enthusiastic. There are always ways to manage that, and I'll go over them in this series. Fifth, market conditions. Look, the wheel isn't bulletproof. If the market tanks, you're still going to feel it. The good news is it's flexible enough that you can adjust and keep moving. And finally, time management. The wheel can be hands-on, but it doesn't have to be. I'll show you how to set it up to match your lifestyle, whether you want daily involvement or more of a check-in every few days approach. The bottom line, These challenges are real, but totally manageable. In this gym series, I'll show you exactly how I navigate each one so you can avoid the potholes and run this strategy with confidence. Now let's talk mindset, because this is where most traders blow up their accounts, including me when I was still figuring things out. First, be satisfied with small gains. This strategy isn't about home runs. It's about stacking singles. Those small wins compound faster than you'd think. Second, you don't have to win every trade. Seriously, the wheel works because you stay systematic, not perfect. Third, it's okay to get assigned. Assignment isn't a failure. It just means you're moving to the next step in the cycle. If you pick stocks you like owning, it's simply part of the plan. Fourth, avoid overreacting to market swings. Your emotions will try to drag you all over the place. That's the panic talking. Don't trade that. Trade your plan. Fifth, focus on long-term consistency. The wheel is a marathon, not a sprint. Small gains grow, discipline multiplies them. And last, stick to your plan. Don't chase losses. Don't revenge trade. Don't let a red day convince you the sky is falling. The plan keeps you grounded when emotions flare up. Now, I'll be honest. I've broken every one of these rules at some point. Sometimes it worked, and sometimes it slapped me in the face. But every mistake turned into a lesson. And that mindset, learning, adjusting, and staying consistent, is how you survive the bad days and thrive on the good ones. Tracking your performance isn't just about watching your account grow. It's about comparing it to the market so you know whether the strategy is actually working. Since June 2022, my wheel accounts have averaged about 25% annualized, or about 22% CAGR, that's CAGR, compound annual growth rate. During that same period, the S&P 500 returned roughly 16%. So not only has this strategy been consistent for me, it outperformed the benchmark. Now that's the big picture. But let me show you something even more interesting. One of my accounts completely stood out. This one averaged about 49% annually, and in just 3 years, it grew by 120%. Now this isn't magic. This didn't happen because I picked a lucky stock. It happened because of consistent premium collection, disciplined exits, and repeating the wheel over and over. I'll include a link to the full tracker so you can see every line of data for yourself. Now I'll be updating the template to include CAGR calculations so you can plug in your own trades and track everything the same. Bottom line, consistent rules beat emotional decisions. Systems beat predictions. And the wheel strategy, when managed the right way, can deliver results that stack up against and sometimes beat the broader market. Here are the big takeaways from everything we've covered. First, the wheel strategy is systematic and adaptable. It gives you multiple paths forward, even when the market moves against you. That's why it's forgiving. There's always another step you can take. Second, success comes down to patience, discipline, and focus. The trades themselves aren't complicated. Staying consistent is a real challenge. And third, you only need a basic understanding of options to get started. Calls, puts, assignment, delta, and strike price. Once you have those down, the strategy becomes much clearer. If you take nothing else from this video, remember this. Consistency beats prediction. Discipline beats emotion. And small gains, stacked over time, beat everything else. Now that you understand the wheel strategy, here are your next steps. Start small. Either paper trade or take just one real trade to get familiar with the flow. And find your basics. Calls, puts, delta, assignments. All the things we covered earlier. And follow along. I'll be breaking down real trades in the gym walkthroughs so you can see the strategy in action. If this helped you, hit like, subscribe, and drop a comment so we can tackle this journey together. And remember, trade the plan, not the panic. See you in the gym.